it's split into a number of sections. And what we need to do is to address each section of the question in turn. It says, go to the requirements first of all. Always in the question, discuss with suitable computations how the above transactions would be accounted for in the financial statements of Leigh. So first of all, we have the acquisition of hash. The purchase of shares creates a subsidiary. The issue of shares by Leigh is treated as the cost of the investment in hash. So this isn't really share-based payment. This is IFRS 3. This is business combinations. The shares issued should be measured at fair value. And what's that going to be? Well, it's 3 million shares with a market value of 6 million. So that is debit cost of investment, 6 million, credit share capital. We're not told what the nominal value, so share capital and premium, 6 million. So this will form part of the goodwill calculation. We're not given the net assets, so we can't calculate goodwill, so we can go no further. We then have the shares to the directors. The shares to the hash directors. And it says it's going to be 5,000 shares per director if they were still employed by Leigh on that date. So the employment at the 31st of the 5th X7 is a non-market based vesting condition. The vesting period is 1 year, because the shares were purchased on the 1st of June X6 and we're going to give them the shares on the 31st of May X7. The total cost shown in the financial statements is going to be, well, it's 5 directors. They were still employed, so all 5 of them, they're going to get 5,000 shares. What's the fair value? Well, they're going to receive shares, so they're not going to be paying anything for the shares. So therefore, there's going to be a zero cost to them. So we have to work out the fair value at the grant date, which is the 1st of June X6. And if we actually take a look at the question, the market value of Leigh's shares was 6 million, and we were giving 3 million shares, so the value of each share must be $2. Now, given that they're not going to have to pay anything for these shares, therefore the fair value at the grant date must also be $2. So that gives us a figure of 50,000, which will be debit income statement 50,000 and credit reserves 50,000. So that's the first part of Part A. We then also have a scheme for our own employees. Do you see what I'm trying to do here? It's not a 10-mark question. It's 3 questions for 10 marks. The more you can break a question down into its components, the better you're going to be in the exam. So in terms of its own employees, it says normally share options would vest over a 3-year period, but these were given as a bonus. So it granted and issued. There is an immediate vesting period. As the grant and the vesting date are identical. So we're not going to be spreading the cost of this share option scheme over a period of time. So what we need to do is we need to work out exactly what is involved. And it says that the shares in Leigh had a market value of $3 million, so 1 million shares at $3 per share on the 31st of March, so 31st of May X7. The fair value of each option stroke share at the vesting date is $3 each, because it's 3 million divided by 1 million. And therefore, what we would do is that we would debit income statement 3 million and credit reserves 3 million. It then says it expected that Leigh's share price will rise to $6 per share over the next 3 years. That's irrelevant because these shares are being granted straight away. This is a bonus, so it's not being stretched over a period of time. So that's what we'd have to do for Part A. If we then take a look at Part B, which is the PPE purchase, the value of the PPE is 4 million. So we will increase PPE in the statement of financial position at the cost figure of 4 million. Per IFRS, if there is a choice between a cash and an equity settled option, calculate the cash value first. Any excess is treated as equity. So how are we going to do this? Well, it says that the supplier can either choose between 1.5 million shares in 6 months or cash in 3 months equivalent to the market value of 1.3 million shares. The cash-based figure at the 31st of May X7 is 1.3 million shares. The value of the shares at that date is $3. So that gives us a figure of 3.9 million. But remember, they don't have to take the cash. They could take the shares. The equity value is the difference of 4 million less 3.9 million. It equals 0.1 million. This is very similar to the way that we would deal with a financial instrument where we have a bond which is part debt and part equity. Here we have the opportunity to take either a debt-based payment in the form of cash or alternatively to take an equity payment. So therefore our double entry is debit PPE 4 million, credit liability 3.9 million, and credit equity 0.1 million. We've then got the issue of the director. This is no doubt this is a very tough, very technical question. But the question is actually very, very similar to what we've just been through. The principles are practically identical. One of the directors has been granted the right to choose either 50,000 shares or receive a cash payment to the current value of 40,000 shares. The right has been granted because of the performance of the director. The settlement date is the 1st of July X8 and the company estimates the value of the share alternative is $2.50 per share. So the cash settled value, how much can he take? He can have 40,000 shares with a current market price of $3. So therefore he could take $120,000 in cash straight away. The share-based value, he could have 50,000 shares, and the fair value of those shares, because he's going to have to wait for a year, the fair value is going to be less than taking cash immediately. So that's 125,000. So the equity excess is $5,000. Therefore, we will debit the income statement with the higher of the two figures, which is 125,000. Remember, if you've got a choice between cash settled or equity settled, you always show the potential cash cost as a liability. So that's 120,000, and we credit reserves or equity with the excess, which is 5,000. So technically very, very challenging, but it's not a lot to write. And very, very few students did this question when it was set because it was such an unpleasant technical issue. It's a very obscure technical issue. Next we move to handy. And again, this is something which I think considered to be very obscure. But we would start off with the basics. Handy is an associate because, firstly, Leigh owns more than 20%. Of the equity shares. And secondly, Leigh has significant influence due to appointing directors and intending to own the shares long term. The cost of the investment is what's it going to be? Is 1 million shares in Leigh at a price of $2.50 each. So it's 2.5 million. And it says the fair value of the net assets of Handy was 9 million. The retained earnings of Handy were 4 and other reserves were 3. We add to this using the equity method, the group share, which is 30%, of the post-acquisition profits. And the post-acquisition profits are 1 million because they're 5 million. If you look at retained earnings, they're 5 million at the SFP date, and they were 4 million at the acquisition date. So that's 0.3 million. Now, we don't usually calculate goodwill in respect of associates. And this is where I thought that the question was being a little bit naughty. Goodwill is only calculated for associates if we believe that it is negative. Now, I wouldn't have guessed, looking at those numbers, that we have negative goodwill. However, what should we do? Well, we've got the cost of the investment, which is 2.5 million. We will add to that a nominal. I appreciate we don't have an NCI, but we're going to have a pretend NCI. And we are told that the fair value of the net assets was 9 million. So therefore, in theory, if we did have an NCI, they would have 70% of that, which is 6.3 million, which takes us up to 8.8, less the fair value of the net assets, which is 9 million, so we end up in this question with negative goodwill of 0.2 million. What's our treatment of negative goodwill per IFRS? We would say per IFRS negative goodwill is credited immediately to the income statement and it is added to the value of the associate. Now, I don't know any students that know that particular point. It's a very, very weird and obscure item. So if you'd just done cost plus share of post-acquisition profits, you would have picked up the majority of the marks. Therefore, the value of the associate in the SFP is 2.5 plus 0.3 plus 0.2. It works out as $3 million. So that's a really unpleasant question. It's not a very long question, but it's fiendishly difficult.